Dividends are one of the most accessible forms of passive income that almost anyone can start building today. Real estate is one of them, and it can be powerful, but it often requires debt, large upfront capital, and doesn't truly become passive until you reach scale. Until then, you're managing tenants and dealing with issues. Dividends are different. Whether you're starting with $100 or $100,000, you can own shares in real businesses that generate cash and pay you a portion of it. And over time, those dividends can really start to compound. And that's what makes dividends so powerful. They start small, but they can scale over time. So the question becomes, what happens if you take that idea seriously for 20 or 30 years? What does that turn into? For me, that's where the idea of building a massive dividend portfolio comes from. So what exactly does massive actually mean to me? Here's the dividend portfolio I've started building on this channel from zero. My ultimate goal is to build this into a portfolio that generates $120,000 per year in dividends, or about $10,000 per month. For me, that would be more than enough to live off of and allow the portfolio to function like its own paycheck. Now, obviously, this is a long-term goal for me, but let's get into the strategy of how I plan on building a massive dividend portfolio over the next 10 to 20 years. As always, this is not financial advice. I'm simply documenting my plan and my journey. So how exactly do I plan to achieve the goal of building a portfolio that generates $120,000 per year in dividend income? My general approach is to not focus on high starting dividend yields. Instead, I'm going to focus on dividend growth. Companies that have a history of increasing their dividends and that I believe can continue growing them sustainably over long periods of time. The starting dividend yield matters far less to me than the growth rate of the dividends and how sustainable that growth is. That's why I'm starting this portfolio with the ETF called SCHD as the core holding. The reason behind this is, one, I'm not working with a large amount of capital yet, and SCHD gives me instant diversification across high quality companies. Second, SCHD aligns directly with my strategy. It focuses on profitable, cash generating businesses with strong fundamentals and a history of dividend growth. As a core holding, it gives me broad exposure to dividend growers while I continue to build up my capital base. It's simple, diversified, and built around the exact philosophy I'm trying to follow. In addition to SCHD, I plan to layer in individual dividend growth stocks when I see compelling opportunities. For example, I recently added Pool Corp. It's a company with strong fundamentals that has faced pressure due to a slowdown in the housing market, but in my view, the core business remains firmly intact and the long-term demand drivers haven't fundamentally changed. I believe it's a company positioned to continue growing its dividend well into the future. The goal is to keep SCHD as the foundation of the portfolio and then selectively layer in high-quality companies that I believe can grow their dividends consistently over time. And I'm going to try to just not limit myself to large cap companies. A lot of the times investors focus on these large names, but I believe mid cap and small cap companies can offer the same strong fundamentals and long-term dividend growth potential as well. These individual stock positions are meant to enhance the portfolio's growth to beyond what SCHD can provide alone. And as always, I'll do my best to be fully transparent about every position I add and why I add it. Now, all of this strategy and long-term planning sounds great, but without actual capital, none of it works. You can have the perfect strategy, but if you're not consistently investing, it's like having a destination in mind with no gas in the tank to drive there. That's why the most important part of this entire plan is the cash I consistently invest into the portfolio, especially in the early years. My plan is simple: make weekly contributions, reinvest every dividend, and direct any additional income I generate into this portfolio. In the early years, the growth of this portfolio will come far more from my own contributions than from the market returns. The goal isn't to time the market, it's to steadily increase the amount of capital working for me. And over time, that consistency becomes the real driver of growth. So that's the plan. Invest in dividend growth companies, use SCHD as the foundation, layer in individual opportunities when they make sense, and consistently contribute every week. And I want to be clear, this isn't going to be a fast, get-rich-quick strategy. In the early years, progress will feel slow. Most of the growth will come from my own contributions. But if I stay consistent, reinvest the income, and give it enough time, eventually this portfolio will begin to build real momentum. Compounding will feel slow at first, and then it will begin to accelerate rapidly. But it's all a part of the journey. If you'd like to follow along on this journey as I build this portfolio in real time, consider subscribing to the channel. As always, thanks for watching, everyone.